The IMF is currently projecting a baseline global growth rate of 3.3% for 2026. Sounds pretty stable, right? But what Wall Street is actively masking right now is a massive structural ceiling that threatens to bring this whole narrative down. In this explainer, we're diving deep into the hard data behind a staggering 30.5 gigawatt AI energy deficit, and we're going to break down the systemic supply shocks that are on a collision course with mainstream market optimism. Let's look at that number, 30.5 gigawatts. The consensus out there paints this rosy picture of endless resilience driven by tech capex and fiscal stimulus. But beneath that 3.3% IMF baseline, we're looking at a hidden infrastructure bottleneck of historic proportions. To put this in perspective, that 30.5 gigawatt figure is the physical power demanded by just one single AI firm. And that demand is crashing head-on into an aging electrical grid that literally cannot support it. Add in the fact that global supply chains are actively fracturing from sudden geopolitical shocks in the Middle East, and well, the math just doesn't add up. Section 1. The 2026 Macro Illusion. Let's unmask this supposed growth. If you look at consensus estimates from the big players, like Goldman Sachs and JP Morgan, they're projecting some highly sturdy growth. The US is pegged at a robust 2.8%, supposedly driven by tax cuts and a tidal wave of AI capital expenditure. You've got China, forecasted at 4.8% on surging exports, and the Eurozone hanging in there at 1.3%. So on paper, it looks like the global economy is just flawlessly absorbing all these recent shocks, propped up by corporate health and front-loaded fiscal stimulus. But actually, scratch that. This data is only telling a very surface-level story. Before we unpack the structural vulnerabilities threatening these exact forecasts, I need to note, the following analysis is strictly for informational purposes only and does not constitute financial or investment advice. Always make sure to conduct your own due diligence or consult a licensed professional before making any capital allocation decisions. Okay, the crucial point here is summed up perfectly by Fabio Bossi, the head of cross-asset strategy over at JP Morgan. He notes that the market environment remains fragile, and investors must navigate a landscape where risk and resilience coexist. What he's really saying is that the front-loaded fiscal stimulus and this massive AI hype cycle are currently masking severe structural vulnerabilities. We're balancing robust capex with surprisingly fragile labor demand and weak business sentiment. Risk and resilience are completely tangled up right now, meaning the margin for error on those 2026 forecasts is razor thin. Let's pivot to Section 2, Geopolitical Fragmentation and Trade. Remember the closure of the Strait of Hormuz in early 2026? That completely exposed the dangerous fragility of seamless globalization. This wasn't just some localized friction. This one single choke point disrupted the flow of roughly 20 million barrels of oil every single day. That is a fifth of global petroleum consumption and a quarter of seaborne oil trade, not to mention 20% of global liquefied natural gas. It instantly embedded a massive geopolitical risk premium into global energy. The macroeconomic impacts, both domestic and global, were absolute and immediate. Here in the US, gasoline surged past $4 a gallon practically overnight. And globally, the IMF was forced to step in and downgrade that baseline global growth forecast for 2026 down to 3.1%, directly in the shadow of this conflict. That durable geopolitical risk premium we just talked about, it is now firmly baked into global energy prices. And this triggers a permanent structural shift. Global decision-makers are no longer prioritizing cheap costs and perfectly seamless supply chains. We are seeing a hard pivot from efficiency to domestic resilience and security. Supply chains are actively being repatriated. Natural resources are being viewed and used as strategic weapons. Access to energy is no longer a given. The direct consequence of this shift is heavily inflationary because economies are literally intentionally sacrificing growth just to build secure domestic buffers. Moving on to Section 3, the AI power deficit. Let's look at these energy bottlenecks. This right here is the defining physical limit of the entire artificial intelligence supercycle. On one side of the equation, you have a single firm, OpenAI, projecting they'll need 30.5 gigawatts of new generation capacity by 2030. On the other side, you have the absolute limit of what the entire United States electrical grid actually added in 2024 after adjusting for reliability. That number? Just 25 gigawatts. It's staggering. A single AI company's power demand is devastatingly outpacing the capacity limit of the entire country's annual grid additions. There's just no way around that physics problem. By the way, if you're finding this data-driven breakdown of global macroeconomic constraints valuable, hit the subscribe button right now. We consistently deliver the institutional-grade macro data and deep infrastructure analysis that you actually need to navigate these complex markets. Continuing with this energy constraint, there's a quote from OpenAI's Sam Altman that is honestly chillingly accurate. He said, "Eventually, the cost of intelligence, the cost of AI, will converge to the cost of energy. The AI capital cycle is fundamentally gated by baseload power generation. It's not gated by software or coding breakthroughs anymore." When you factor in combined cycle turbine delays, massive grid interconnection bottlenecks, and a severe labor shortage for energy installation workers, energy availability becomes the absolute, unbreakable ceiling on AI abundance. Yet despite these glaring physical grid constraints and the massive geopolitical shocks we literally just covered, Wall Street's institutional models are completely unyielding. JP Morgan Global Research is still estimating that the AI supercycle will drive 13 to 15% above trend earnings growth for the S&P 500 for at least the next 2 years. This unbelievable momentum is exactly why equity markets are polarizing so radically into this winner-takes-all dynamic between AI and non-AI sectors.
So let's look at the hardware side. Section 4, Hardware and Supply Constraints.
Right now, we are witnessing unprecedented industrial monopolization. Look at the data. We are tracking a historic low data center vacancy rate of just 1.5%. There is literally nowhere to put new servers. On top of that, an incredible 52% of all global DRAM memory capacity is aggressively allocated purely for AI in 2026. And the crucial semiconductor packaging capacity at major foundries like TSMC, it remains severely tight. That directly caps how many custom chips hyperscalers can physically produce, completely regardless of how big their budgets are. The structural imbalances here are just glaring. Over 75% of new data center construction is pre-leased before the concrete is even fully poured. Think about that. And that 52% AI DRAM demand? It's actively crowding out non-AI consumer and standard industrial sectors. It's forcing all this capital expenditure into incredibly narrow channels. What this hardware sprint really means is that even if the energy was somehow magically available, the physical supply chain itself is stretched to its absolute breaking point. Finally, Section 5, the asset allocation solution. How do we actually position for this? Navigating this landscape of fragmented trade and extreme physical AI constraints requires a very specific diversification strategy. The institutional playbook right now calls for capturing those projected double-digit equity gains through broad global ETFs, spanning both developed and emerging markets. But crucially, you have to hedge this equity exposure. That means making strategic allocations into hard assets. We're talking metals and commodities to directly offset that geopolitical risk premium, and real estate, specifically data centers and industrial infrastructure, to capitalize on the exact physical gridlock we've been tracking today. Holding hard assets and physical infrastructure is what directly offsets the single point of failure risks that 2026 has completely exposed. Resolving these risks demands heavy capital flow into diversified pipelines, specialized real estate, and secure energy generation that circumvents the theoretical tech hype and anchors a portfolio in the hard, physical reality of what the global economy desperately needs to build over the next decade.
To fully understand the precise hardware bottlenecks that are throttling this growth, check out our deep dive explainer on the 2026 global semiconductor supply chain constraints next. We break down the exact semiconductor choke points you need to know about to complete this macro picture. Click the explainer on your screen right now, and I will see you over there.